Hello and welcome to our blog. This blog concerns the errors that high-rate taxpayers make when they do not file a self-assessment tax return. HMRC have calculated that there are 4.6 million taxpayers in the UK paying high-rate tax, i.e. tax at 40%. However, a recent survey conducted on a sample of 4,000 high-rate taxpayers found that at least 76% of them do not complete a self-assessment tax return. The usual reason for high-rate taxpayers not filing a self-assessment return is because they believe that tax is automatically deducted from their earnings through the pay-as-you-earn system, and that pension tax relief is dealt with automatically through their pension provider. This may be a mistake. A high-rate taxpayer taking this approach should review their situation to ascertain whether they should be filing a self-assessment tax return, either as they may be legally obliged to register for self-assessment, or by not registering for self-assessment, the taxpayer may be missing out on tax relief. A higher rate taxpayer may be obliged to register for self-assessment because of the high income child benefit tax charge, which came into force on the 7th of January 2013. From that date, if either you or your partner has an income over £50,000, then HMRC will start to recover any child benefit you or your partner have received. If you earn £60,000 or more, then all of the child benefit received will be paid back to HMRC. HMRC uses the self-assessment system to capture the necessary repayment. Our experience has shown that HMRC will investigate any return where income is greater than £50,000 and the taxpayer and their partner are receiving child benefit. We will now look at the three most common reliefs that high-rate taxpayers miss because they do not file a self-assessment tax return, starting with the most important, pension tax relief. If high-rate taxpayers pay into a private pension plan, then they should be claiming high-rate tax relief through the self-assessment system. This is unless they are contributing through a system called salary sacrifice or salary exchange. The easiest way to understand this is to look at an example. Here, John's total income is £80,000 and he pays total annual pension contributions from his post-tax income of £8,000, £10,000 gross after tax relief at source is added. As mentioned on the previous slide, John receives basic rate relief from HMRC, requested and received by the pension provider, of 20% of the gross contribution made, which in our example is £2,000. However, John should also receive relief at the high rate of tax, that is, a further 20% above what was received at source. This is done by extending the basic rate tax band by the size of the gross contribution, i.e. £10,000. So in our example, by completing a self-assessment, John can reduce his tax liability by £2,000. A recent survey showed that 30% of high-rate taxpayers do not make a claim for high-rate tax relief on their pension contributions. The next common failure that high-rate taxpayers make is the failure to claim for charitable donations made under gift aid. Charities receive basic rate tax relief at 20% on gift aid donations received. Charities will therefore receive an extra £25 for each £100 donated. That in itself is great, but even better is that high rate taxpayers can also claim an additional 20% relief, meaning that each £100 that they donate will reduce their tax bill by £25. Again, a recent survey showed that 59% of high rate taxpayers do not claim tax relief for charitable donations. The third common failure that high rate taxpayers make is not taking advantage of the HMRC approved mileage allowance rates when receiving mileage allowance payments from their employer. This opportunity comes from the fact that most employers do not pay HMRC approved mileage allowance rates when paying mileage allowance to their employees. Therefore, any taxpayer, not just high rate taxpayers, can make a claim for the difference between the HMRC set mileage rates and the amount actually received from their employer. Let's look at an example. Eddie is a higher rate taxpayer employed by ABC Limited. During 2015-16, he used his private vehicle for 12,500 business miles for ABC Limited. ABC Limited paid Eddie mileage allowance of £2,500, which equates to 20 pence per mile. Using the HMRC approved mileage allowance rates, Eddie calculates that he could have received 45 pence a mile for the first 10,000 miles and 25 pence a mile thereafter. By using these rates, Eddie could have received £5,125. His employer paid him £2,500, so Eddie can make a claim for an additional £2,625 of tax relief. As he is a high rate taxpayer, Eddie will see a reduction in his tax liability of £1,050 based on the 40% tax which would have been paid on the £2,625. So what can the taxpayer do if they have failed to claim these reliefs? The answer is to write to HMRC as soon as possible. The taxpayer has 4 years from the end of the tax year in question to bring it to their attention. For example, if the taxpayer discovers that they paid too much tax in the year 2012-2013, which ended on the 5th of April 2013, then the taxpayer will have until the 5th of April 2017 to claim a refund. After the 4 years, the tax relief will be missed, and nothing can be done. When making the claim for repayment, the claimant should include the following points. First, details of which tax year the claim is for. Second, an explanation for why they overpaid tax in that year. Third, evidence of the tax that the taxpayer did pay in that year. Fourth, the taxpayer's signature. And finally, details on how the taxpayer would prefer to receive the refund. The next point we'll consider is what a taxpayer can do when they have filed a tax return but realise that they need to make a correction. The answer is that they can make an amendment. The deadline for making amendments to a tax return is very generous. The taxpayer has 12 months from the 31st of January after the end of the previous tax year to make their corrections. This means that for the tax year 2015-16, the deadline for payment is the 31st of January 2017, and the deadline for amendments is the 31st of January 2018. If after viewing this video blog you believe that you can make a claim for these or any other reliefs, do contact us and we can help you look into it further.